Finance Minister Nirmala Sitharaman will likely present her fourth union budget on the 1st of February this year. Now, with the Omicron variant of the coronavirus already having triggered the third wave in India, the ripple effect on the economy may be felt in the coming months. The Indian economy has been steadily recovering from the havoc wreaked by the pandemic. Equities touched record highs in 2021 with trade, agriculture, private investment, and government spending hovering above pre-pandemic levels, coupled with a strong demand outlook. But the resurgence of infections in the country has come as a dampener, and whether the economy is able to sustain the growth trajectory will depend to a large extent on the policies of the government. I'm your host Gautam Srinivasan, and today on our special presentation, we will explore what investors can expect from Budget 2022. Joining me on this conversation are Lovaii Navlakhi of International Money Matters Private Limited and Bhupesh Bameta of Aditya Birla Sun Life Mutual Fund. Gentlemen, it's great to have you come in and provide your expertise on the topic. Bhupesh, we'll start with you. Last year, the union budget took place just before the second wave of the COVID-19 pandemic came in, with surging commodity prices and more accommodative policymakers across the world. So the move to expand fiscal deficit to support growth that came in, that was understandable. The macroeconomic backdrop in which the budget is being presented today during the third wave, it looks a bit more complex. Economic recovery still looks a bit narrow, with FY22 real GDP being just about 5% above FY19 levels, which is a 3-year CAGR of sub 2%. Plus, some deceleration in domestic demand was seen in recent months amid weak IIP numbers despite strong exports, flat auto sales, and moderation in the growth of the cement sector. So the need for a fiscal support is still there, but nominal GDP and inflation are seen as likely to moderate in FY23, and along with excise duty cuts, which could result in tax revenues being less buoyant. So in the context of how all of that happening, how do you see the government balancing growth with fiscal prudence in this budget?
So very rightly pointed out, the economy is recovering, but a lot of things still has to be done. What we are seeing right now with the K-shaped recovery, so certain segments of the economy are doing pretty good, and they have recovered almost closer to pre-pandemic level. But there's a big segment of the economy, and particularly things like informal sectors, high contact sectors, segments which are more vulnerable and where people typically gets less paid. Those segments are still reeling under pressure. While optically the GDP forecast for this year is around 9%, next year also closer to 9%. But if you compare it with the pre-COVID trend, we are still 10% below the pre-COVID trend. So a lot of work still needs to be done, to bring economy back to the pre-COVID levels and to remove the scarring which is there in many segments of the economy. As you rightly mentioned, global backdrop is also not as sanguine as it was last year. Inflation is rearing its head across the world, and that has two implications for India. One is that commodity prices are going up, and we are a big commodity importers, unlike many other EMs. Oil in particular is a big segment of our imports. So that will have a lot of pressure both on inflation front and the fiscal front. And secondly, global central banks are withdrawing their super easy monetary policy. So that always has an implication for countries like India in terms of capital flows. So typically we are a net current account deficit economy. And whenever capital account turns negative or is under pressure, a currency typically comes under pressure. So global backdrop is not that segment. Another thing is that, last 1 year in particular was super in terms of global demand, particularly from US and also from Europe. Now, whenever US, which is a big importer, whenever they grow very fast, all the EMs, all these boats gets lifted. But now US is, with policy getting tightened over there and inflation becoming the center point, there's a possibility that the strong demand that we got from US, which helped our exports in a big way last year, and others, engines were not firing that much, that may get a little bit tempered. The global backdrop is not as sanguine as it was last 1 year. Pandemic is still there, albeit one can say that, from first wave to second wave to third wave, the economic impact of pandemic and maybe also now the health impact of pandemic is turning out to be much lesser than it was in the past, but it still is there, and it is sapping, confidence. And unless people have a greater outlook, a better outlook of how this pandemic will turn out, capex in particular will wait. So that's remains a source of concern. The K-shaped recovery is another big source of concern. The positive side, I would say, is that even last year itself, government has created a space for themselves in terms of fiscal So just to give you a backdrop, I mean, from last 4 years before the pandemic, the average fiscal deficit used to be around 3.8% of GDP. This year, I mean, last year they increased that to 6.8%, and then they have this roadmap where they are reducing the fiscal deficit from 6.8% to 4.5%, but by FY26. Now, so we do expect that deficit will come down from 6.8% towards maybe 6%, but compare that to 3.8% average deficit that we had in the pre-pandemic years. So government has already given themselves this buffer, and markets are pretty okay with it. Rating agencies are pretty okay with it. So that is one buffer which government has, which they can use, to keep supporting the economy. But clearly, with global backdrop what it is and the state of economy that it is, the task is challenging for the government.
All right, Bhupesh. Now, indeed, it's a tightrope walk, not just for the Indian finance minister, but for a finance minister of any global economy, considering the fiscal firepower is also reducing as these issues come about continuously. Lovaii, let me come to you to respond to the points that Bhupesh has mentioned. According to you, what are the challenges for the economy that the Indian government will specifically look to address in this budget?
Thank you so much for having me. And as Bhupesh mentioned, it is really a tightrope walk. It's really very difficult to make predictions in terms of which direction the finance minister will go. Because on one end, you want to push the economy back on track and get it to grow. And at the same time, the inflation numbers are really worrying. So at some point, you might want to increase interest rates to protect the inflation from running away too much. And both these factors are sort of countervailing. And to that extent, it's a tough tightrope walk. I think that at this point in time, because of the uncertainties around the effect of the pandemic, I would not like to stick my neck out and make a prediction as to which way the finance minister should go. In fact, I do think that she's in a very tough spot at this point. And the way I would deal with a situation like this would be to experiment with maybe a few sectors, maybe do a few things that need to get in place first, so that there is time to evaluate the impact of that and then go forward. So as long as people know that this budget and these predictions are for 2022 to 2026, we'll all be fine. But of course, we like to judge, quarter on quarter, year on year. So it's going to be a real tough ask. I think the government might want to take a stance as to which particular type of industry, type of sector they want to promote. So is it, let's start pushing manufacturing back on track. So do all the shops on that side, but tighten things on the services side, or do a combination of that, or play the card of agriculture and say, okay, what else can that economy contribute? I think it's a really, really tough ask. And frankly, I am not sure I should pin and say, yes, consumer, yes, infrastructure. I am really unsure at this point in time.
And let's not forget, it's also a regional election year, so there's an additional pressure on that front as well. But to borrow a term from the technology space, I understand your viewpoint that it should be containerization of ideas and see how it works with different sectors and use what works. Extending that to Bhupesh, what do you think will be the key thrust of the budget, Bhupesh? Do you think rural economy could be back in focus, since in the first 8 months of FY22, spending towards rural contracted by 25% year on year?
Yeah, given all these tightrope walk, I think, one good thing right now is that the tax collection over the last 7-8 months, they have been pretty strong. So if you look into tax to GDP ratio, they are now back to pre-COVID trends, 11% plus. That's one very good thing which the economy is seeing. I think probably what we are seeing are the benefits of all the formalization and all the tough thing which we had done, GST, Benami Act and all those things. I think they are now visible on the ground. So that's one positive thing. So what has happened now over the last 2 years, specifically the last 1 year, government had spent a lot of money, to ameliorate the impacts of pandemic. So the expenditure over there has gone up significantly in things like vaccination, Narega, all these health infra things. Now, probably if we are towards, if the pandemic is turning to an endemic and bulk of vaccination is behind, What it does is that a lot of spending which was done over the last 1-2 years, I think that money may be spent somewhat less this year. So that opens some space for the government to keep on spending while keeping fiscal not allowing fiscal to blow out. That's one thing. Rural definitely, as you rightly mentioned, would have a key. It would be a key focus area for the government. The second thing I would say is that while rural areas do have schemes like Narega and all these PM Kisan scheme, it's the urban poor which remains very, very vulnerable. And these are people who are mostly in the high contact sector, informal sectors. They are the ones who have been hit the hardest by the pandemic. Now, some of them have gone back to their homes in rural areas, and they are benefiting from Narega schemes, where we are seeing a lot of pickup. But I think some sort of help should be provided and may be provided this time for this rural, urban poor. I think that would be one thing. Secondly, I think capex, the government's philosophy has been more towards supply side economics to the extent possible. And last year also they had 30% YOY growth in capex. I think this year also, if they're able to save some money from those pandemic-induced expenditure last year, they can have greater expenditure on the capex front. Having said that, government's capex as a percentage of overall GDP is a very small fraction, around 2% of GDP. So even a 30% type headline numbers doesn't make much of an impact. But I think this is one thing which government can target this year to focus more on all these infrastructure-related things. They have been doing it a lot. But because of pandemic, actual spending wasn't that easy because, unlike we people who can work from home or all these digital connected people, a lot of government work happens in office. So when we have pandemic, governments aren't able to function as effectively. And hopefully with this third wave, we may be hopefully I'm saying, we may be towards the end of the pandemic. And that may allow government to, spend more aggressively on building capex, which can lay foundation for a long-term non-inflationary growth in India. Okay. That would be my wish list also, and I think that would be one thing which government may be targeting. Besides some aid to urban poor.
All right. And any SOPs for business, especially, when we look at working capital, the many discussions that I have with companies, that's a central issue which is coming out. More working capital, especially if the government's focus is on the supply side and addressing those issues, because we've been discussing this, that demand is there. The issue is going to be how that demand is catered to. So are you expecting more SOPs from the government for businesses, especially to boost their working capital?
2 years ago, 2.5 years ago now, government had given a big SOP to business in terms of corporate tax cut. It was a pretty strong cut from government, and it's a big signal of intent to the corporate sector that we are with them. So I think purely in terms of any big SOP going to the corporate sector, that may be a little less likely. SMEs and all, they can be some SOP because they have been pretty badly hit. So some SOPs can happen, to ease out these working capital requirements for SMEs. That is quite possible. Yeah. Mm-hmm. But overall, the thing is that what government needs to do is target more those segments of the society, of the economy, which have been very badly hit. And I would say that is mostly the informal sectors, high contact intensive sectors, restaurants, hospitality sectors. They have been pretty badly damaged these 2 waves. These 2 years, and preventing scarring in those segments should be the key focus for the government.
All right, and in terms of parity of taxation, a lot of the complaints from SMEs is also that corporate tax rate is one. The larger enterprises are much more tax efficient than them. Anything on the tax front that you expect for small and medium businesses at least to come in to bring them on parity with the usual corporate tax rate?
Generally, in terms of corporate tax, that is pretty much same across the board. But I take your point that many of these corporate works as family enterprises, and a lot of they don't have some of the means to reduce their tax burden that larger corporates have. So some of this can definitely happen, especially given the fact that the tax to GDP ratio has been going up pretty smartly. Overall, tax collections have been pretty strong. So the whole theory of being more efficient in taxation is that then you can reduce the per unit tax. So that is one thing which government can surely target. But as you know, as our panelists already mentioned, we're also in a political year. Elections are also going on. So managing all these conflicting, targets is going to be a little challenging. But I do think some softs can come, both for SMEs and all, and also for even for the income taxpayers. I think there also income tax. The amount of taxation which has government is getting from income tax, that is also going up pretty smartly. Probably again the same things, all these formalization and linking of GST and income tax. So there is some scope for government to give some support to the economy.
All right, let's shift focus from the broader economy to more relevant questions for investors. Lovaii, the debate on securities transaction tax that has gained momentum, with media reports suggesting that there are calls from various corners for abolishment of STT. What are your views on that?
I think that one of the important reasons why this is happening at this point is the flurry of investment that has happened by investors in the equity markets, and they've made good returns. And I think many of the investors are first timers, so they have been booking profits off and on. And every time they see in their that they make their sale, there is a securities transaction tax. I think the securities transaction tax came in, what is it, 15, 17 years ago. And the whole idea was to bring in some sort of accountability and make sure that everyone who's trading in the stock market is covered. Of course, in the initial years, there was a benefit of exemption from capital gains tax if there was a STT that was levied. So frankly, I don't know what the UN cry is about at this point in time, because I don't think that the values are anything significant and large. They become large if I am going to use that equity market to continuously trade, to do a lot of futures and options, get into some bit of speculation. Then yes, an STT cost sort of hits me. Otherwise, the STT cost is not a very large sort of amount on an individual basis. I know there is a case saying that the government is also not getting a huge sum of money through STT. I think the numbers for the current year might be quite different, and it could be a larger number that they are getting now. And I think it's fine. It's part of the rules of trade, and you live by those. So I'm not for one to push this, because you might actually encourage more short-term trading. And we as advisors are always talking about look at things from a long-term point of view and not play this like a casino. So I would say really no action needs to be taken there.
But what about, say, then LTCG, right? LTCG tax on equities. That's also among one of the bigger expectations from retail investors, especially since so many have joined the mutual fund bandwagon. Do you think that will happen? What about increase in tax saving limits for ELSS? There's still lots of ground to cover.
Yeah, I think, see, the overall incentives for, investing, etc. Yes, there could be play. And there is a talk for example, to say that if I'm doing anything specific with regard to retirement planning, there should be certain additional tax benefits to me, because otherwise the government really does not have a social security system in place. That maybe, again, from a long-term point of view, sort of makes sense. See, on LTCG, I would have thought a few years ago that LTCG would not have come in at all. Now that it has come in, I'm not so sure whether it'll get removed as quickly. It's 10%. It's still on the lower side as compared to most countries across the globe. I don't know of too many countries which have no long-term capital gains tax on equity. So I'm again not sure. I mean, yes, we can. It's a good, what should I say, battle or a morcha to take out and try.
You could call it the cost of doing business.
Yeah, I would think so. I think, see, the in fact, if anything, I think the short-term capital gains tax should go up. Then you'll start feeling, oh, long-term capital gains tax is great. 10% is great. Right now, there is not much arbitrage. So you still feel, it's okay, let me book some short-term capital gains and pay 15%. Yeah, now you're trying to push it to LTCG to zero. And I'm sure then there'll be, clamor to bring down even STCG to, a lower figure.
That's always that. Like I said, it's always a tightrope walk from a policymaker's perspective, because while you might address one issue, another issue crops up. So it's a perpetual battle of expectations. But moving on from that to the fact that there is buzz around India's bond inclusion in global indices. Bhupesh, let me get a response from you. In terms of impact, it's actually seen to be a neutral move, because if there's a lot of demand among foreign investors for G-Secs, which pushes prices of bonds up and lowers yield, but at the same time, say it strengthens the rupee, which hurts exporters. How do you think it's going to pan out in terms of impact if that move actually happens?
Yeah, we also expect some forward move on this bond inclusion thing by the government in the budget. There is a lot of talk about some taxation issue which Euroclear has, which may be sorted out in the budget. Having said that, we need to have some, just to give some idea about how big this amount, how big this whole thing can be. In our best case estimate, even if all the right things are done in the budget, the actual fund flow will start only from the second half of the current fiscal, of the next fiscal. That means from October onwards. So first is that the money is going to come with a lot of lag. That's point number one. And second, the amount of money which we are expecting is not very large. So in FY23, in our best case, we should be getting somewhere around 10, maybe at best we can get around $15 billion, but mostly closer to $10 billion. That's around 75,000 crore rupees. Now compare that to the market expectation of the level of overall borrowing. That is likely to be more than 12 lakh crore rupees. So from a 12 lakh crore rupees, this is going to be around 75,000 crore rupees. That's point number one. Point number two, in terms of whether this will have an impact on rupee appreciation and all, we should also be factoring the fact that over the last last one quarter in particular, our current account deficit is likely going up. Our trade deficit over the last 4-5 months have been making new records, both because of higher demand for electronics, higher demand for gold, and also because of rising commodity prices, particularly oil. Much of the last 2 years, we had seen a very benign current account, sometimes even turning to surplus. But this year, I think the odds are high that we may be looking at a pretty big jump in current account deficit, maybe towards between 2.5% to 3% of GDP. So what I want to say is that some capital will come through this bond inclusion route, but because the current account deficit is also going to rise pretty sharply, I don't think there's a concern about rupee appreciation in this backdrop. And add to that, global central bankers are reversing their easy monetary policy. So the capital flows, which have been so benign in the last 2 years, even that may turn somewhat less benign and maybe even adverse for India. So net, if you just look into the whole picture of higher CAD, return of maybe less benign capital account scenario, I think $10 to $15 billion is not that big an amount which can have a big impact on currency. So I don't buy this argument at this juncture. Well, philosophically, this argument is correct that if more money comes to this route, rupee may strengthen, RBI may have to intervene. But in the current paradigm, I don't think this argument holds much water.
All right. In the backdrop of this easing of easy money policy, where it's tightening up, what are your expectations, or rather the market expectations from the budget in terms of key budget numbers? We've discussed fiscal deficit. If you could recap that, market borrowings, direct taxation, what's going to happen on that front? Give us a recap of all the key things to expect from this budget for the average viewer watching this presentation.
Yeah. So fiscal deficit, I mean, the one number which bond market looks at very carefully, that should see some consolidation from around 6.8 to 7%, which we saw in FY22, towards 6, maybe 6.4% in that range for the next year. So that's a 0.5%, 2.67% decline that we are foreseeing. Again, I mean, I would like to draw the attention that this number used to be around 3.5% in the pre-COVID era. So while it is consolidating, it's still a very high number compared to what markets have been used to, funding government. In terms of overall borrowing numbers, the numbers are again going to be very high at 12 trillion rupees or 12 lakh crore rupees plus. That number used to be around 6 to 7 lakh crore rupees in the pre-COVID era. So it's a big jump in borrowing. Now, the thing has been that over the last 2 years, RBI has done a lot of OMOs to support this borrowing, closer to 3 lakh crore rupees in the last 2 years. Now, this year, because of the concern on inflation and because liquidity is already very high in the system, and RBI is showing some discomfort with this high liquidity, RBI support in terms of OMOs are likely to be much lower than what we have seen in the past 2 years. On the other hand, bank credit growth is also beginning to pick up. And in that backdrop, whether banks will put their money in the government government bonds, or give actual credit to the economy, that also become a challenge. So while the number 12 trillion rupees is somewhat similar to last year in particular, but still, given that there will be lesser support from RBI, and banks also will have this, this competition of credit to the economy. I think funding this high fiscal deficit is going to be a challenge. And in anticipation of that, bond yields are, picking up, pretty much across the yield curve. So compared to, still 3.35% reverse repo rate, we are already seeing a 10-year benchmark going to 660. And that's a very, very, very steep yield curve that we are seeing right now. Pretty much showing bond market discomfort with the anticipated higher borrowing. And I think the big challenge both for the Reserve Bank and for the government will be how to, keep supporting the economy without, having the negative repercussions of very high borrowing costs for the government, which ultimately gets transferred across the segment, because the government is a sovereign borrower, and whatever yield they get, everybody else gets somewhat more than that. So last 2 years, monetary policy was very, very easy. Now that is getting reversed. Fiscal has to do now more heavy lifting, and how to ensure that this nascent recovery that we are seeing in credit growth, the nascent recovery that we are seeing in capex, how to sustain that without big jump in the borrowing costs. Now that's going to be I think the biggest challenge which both the government and the RBI is going to face. In terms of taxation, as I mentioned, the good thing has been that I would say the brightest spot over the last 1 year has been that tax collection have picked up pretty smartly. We are back to pre-COVID trend in terms of tax to GDP ratio. That is quite positive, and I think that provides some. So that is partially because of this higher excise duty on petroleum. But even if you remove that excise duty, which government had early imposed, and part of it which they have rolled back, even if you remove that, the overall taxation have been somewhat good. So that does give government some leeway to ease, to give some relief in terms of taxation, especially to the vulnerable section, and maybe also to the middle class in terms of. I would say there's a decent possibility that they may give some income tax relief as well, because income taxes have also been going, pretty smartly. And in order to support overall demand, I think there is some scope for some tinkering at least, or some relief on the income tax front as well. Fuel tax, I think they've already rolled back a lot of it, and I think that if fuel prices if crude prices go further up, they may also look to reduce some of it even more. So there's some scope to reduce fuel taxes because they are still higher than what we had in the pre-COVID era. So some possibility over there as well. Otherwise, in other indirect taxes, we mostly have GST, and that is not under the purview of the budget. That comes under the purview of the GST Council. In customs, given all this, Make in India campaign, all these PLI schemes and all, I think over the last, I would say, 4 or 5 years, government have been steadily increasing the custom duty in many articles, mostly to encourage production in India. I think that trend may continue. And in certain food articles, but particularly in palm oil and all, where India has been importing all these commodities where we are we don't produce enough, some tax relief can come on that segment. That's pretty much our taxation expectation.
All right. And in terms of just a headline for the budget, would it be seeding for growth in a post-COVID world? Your expectation, Bhupesh?
I think that should be ideally the case, because we have this concern on inflation, we have this concern on global things and all. But the key, for an economy of India's potential, we are lagging pretty much what our potential is. And I think government has clearly shown their commitment, especially in the last 2 years, to push for growth. And I think this year, again, given a lot of expenditure that they had done in COVID era towards relieving pandemic, should be behind us. I think the key focus for the government will be on boosting growth to the extent possible.
All right. Boosting growth for a post-COVID world. Let's see if that headline pans out. But Bhupesh has very nicely explained all the data points that you should watch out for during the budget. But as we wrap up the conversation, Lovaii, your thoughts on the sectors which you think will benefit the most post-budget? As I was discussing with Bhupesh, manufacturing has seen production-linked incentives and everything else coming in. Do you think it's going to be a more services push this budget?
I'm not so sure, Gautam, that it will only be a services push. But it is quite likely, in my opinion, that a little bit of the thrust towards the informal sector may be slightly higher. You know what Bhupesh spoke about, the urban poor, etc. From that point of view, I think there needs to be some greater allocation there. I think the thrust towards manufacturing will continue. So even if there is something additional coming for the services sector, I do not think it will be at the cost of manufacturing. That seems to be a big sort of strategic movement that the government has made. So I'm guessing that there'll be more coming from there. I also guess that I think the whole issue today about not having enough sort of money for people in the for people who are retired. So while you're specifically asking from a economy standpoint, I think the budget will also be an opportunity for nudging behavior. And if certain things that the government can do to nudge investors to start doing certain things, like for example, the thrust towards planning and creating your corpus for retirement and various sort of products around that. I'm guessing that will happen. So some of the financial services sectors, it could be companies which are focusing on retirement products, it could be insurance products, etc. I think will also get some benefit. Fingers crossed on what the government can do. And as I mentioned earlier, it is indeed a tightrope walk. So I do hope they get all the cards right.
Well, we sure hope so. It is indeed a very tightrope walk and very tough balancing act for the finance minister to do. So let's see how things pan out on budget 2022. But on that note, it's time to conclude this special presentation exploring what investors can expect from budget 2022. I'd like to thank both Bhupesh and Lovaii for sharing their insights with us, and thank you to our viewers for tuning in to understand the finer nuances around the budget and how to frame their expectations accordingly. Also, don't forget to tune in to Nivesh Mahakumbh 2022 on February the 5th, 11 a.m. onwards, as we look at implications of the budget, what it means for investors, and the road ahead in terms of financial planning in a mega virtual event that will see industry leaders and financial experts engaged in a variety of discussions. For now, though, this is your host, Gautam Srinivasan, signing off. Have a great day.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.